Hello, everybody, and welcome to Your Money Story. I am your host, Renita Young, and today we have another fantastic guest to talk about choosing an investment strategy that's right for you. So I'm going to bring on in a minute Jeremy Schneider. He created the Personal Finance Club and the blog, which has gotten a lot of viewers over the years that he created it. And so a little bit about Jeremy's background. He is an entrepreneur first who never wanted to work for a big company. In fact, he turned down a deal to work with Microsoft, but he built up his own company, Rent Links, and then he was able to sell it for $2 million a few years ago. And after 2 years of still working for the company, retired at 36 years old. So now he helps people like you and I get better investment strategies. And so we're going to bring him on in a quick moment. Hang on for a little bit. Jeremy should be coming on very shortly. Hi, Jeremy. How are
Hi,
you?
Renita. Good. How are you?
I'm well. Thank you so much for being with us.
Thanks for having me.
Of course, of course. I told people a little bit about your background. Entrepreneur. Obviously, everyone doesn't have 2 milli from a sale of a business. But what I love about your blog is that you teach all of us how to manage our money well. And so, what I want to know from you first is how did you grow up relating to money?
Thanks. Yeah. I was like a middle class family, I think. We weren't, my parents, I think, were raised pretty poor but they both went to college. And so, I went to public school and we were very frugal growing up and they were very careful with money. But I'd say I had pretty good, financial role models. So I'm definitely like one of the fortunate ones who like had parents who like, talked about money and were good with money. But then as I entered adulthood, didn't really lean on them much. I started my business out of college and grew it on my own. Thanks, I think in large part due to their good financial role model.
Okay. Sounds pretty good. And so one of the things that I read about you is that you never really wanted to work for a big company. And in fact, you turned down an offer with Microsoft. And so just tell me a little bit about your dreams to do something different in your life.
Yeah, so in college, I actually worked for Microsoft for 2 summers as a college intern. I studied computer science, and then I had a full-time offer from Microsoft, and turned it down as like a punk 21 or 22-year-old or whatever it was. Um, and yeah, I didn't really like the idea of like killing myself 40 or 60 or 80 hours a week, and then not really seeing a big difference in either my own like outcome or the difference to the company because it's such a big company. And so I really wanted to just go on my own. And I like much better the idea of like, if you work much harder, then you see more of the benefit yourself rather than just like the multi-conglomerate Microsoft, like doing, not that Microsoft's a bad company. It's a great company. They're like very nice to me. They had like, all that good stuff. But I think I just much preferred charging through my own path so I could, reap the rewards. And, it took like 12 years, but it finally paid off. So I guess I'm glad that I did.
It did pay off in a big way. Again, folks, Jeremy was able to sell his business Rent Links for $2 million. Was it 6 years ago now?
I actually sold the company for over $5 million.
Okay.
My share after taxes was about $2 million. So I owned 70% of the company, which was 3 million, and then I sent $1 million to the government of California and the federal government taxes, and then I was left with 2 million, which, as you said, is very nice. Which I've since grown to over almost 4.5 million now, just from investing over. Yeah, I sold it in 2015, so yeah, 6 years ago.
Yep. So, and that's what we're here to talk about, investing. But before we get there for a moment, how did you make the shift to starting to help people understand personal finance better?
Well, it actually kind of started when I sold my company, where my whole life I was very frugal, and when I was growing the company, the most I ever paid myself was $36,000 a year. I was like, I like, had employed a bunch of people who were many were making 6 figures. I was driving a 99 Ford Explorer, living with roommates. And so I was like living very frugally to grow my company. And then when I sold the company, I basically like literally I refreshed my bank account one day. I actually have a video of it on my Instagram where you can see my bank account go from like a normal amount of money to like over $2 million. And then I was like, what do I do with this? And so I started reading every book I could and watching, or listening to podcasts and watching YouTube and trying to really understand this stuff. And basically every single book, and the goal, of course, being I didn't end up one of those stories like the garbage man who won the lottery and then became a garbage man again.
Right.
I wanted to like keep some of that money. And so I read all these books on personal finance, and they all basically say the exact same thing. They say like spend less than you make. They say invest the difference. They say buy and hold index funds. And I was like, oh, this is actually pretty simple, but it's not a message that is like, received a lot in just pop culture. Pop culture, you hear about buying fancy cars and making it rain and debt and credit cards and all this crazy stuff. And so I started helping my friends. Like we would meet on a random Wednesday night and like drink and like set up their Roth IRA or something. And we'd call it Personal Finance Club as like a joke, like, hey, you want to come over for Personal Finance Club? And then, now I'm basically like, starting another business essentially called Personal Finance Club, which is to help people with financial literacy.
Very good. And you also have courses on your website. I should note that. And so we keep getting comments. First of all, you're getting a lot of love in the comments. And second of all, one of the things people keep saying about you is how digestible your information is. And I totally agree, especially with your infographics on Instagram, right? So like, who are you thinking about when you create your posts? Are you thinking about that fresh out of college person, or are you thinking about the person who maybe in their mid-30s who are just thinking about personal finance for the first time? Like, who are you thinking about?
I think it's both. I think it's people who are, relatively new to investing in personal finance, which is, I'd say, 80% plus of people. And I think a lot of people feel some like guilt or shame around that. Like people are always like I had someone say, oh, I'm 24. I'm really behind. Like, I don't really understand stuff. It's like, you're 24.
Get out of
here. I know,
here.
you and me, like, get the hell out of here, 24. What are you talking about?
24?
I was like, I blocked that person. I said, get the hell out of here. Call me when you're 40. No, I'm just kidding.
Right.
But like, it just like goes to the mentality where like, I feel like everyone thinks someone else is doing something. But I think most of us are in the same bucket where it's like, we don't really understand the ins and outs of investing, IRAs, 401ks, roll, like all this like crazy complicated stuff. And so, but I'm trying to, and I've seen some of those comments too, people say that I make it digestible. I'm trying to say like, hey, it's not that, you don't need to be like on the floor of like the New York Stock Exchange, like waving pieces of paper, or like trading pork bellies. It's like, you need to like, do the simple things, right? Like spend less than you make, like open an investment account, put money in, buy the simple, inexpensive thing. Like and it's not really, some people say, oh, that's a good beginner strategy. It's like, yeah, but the beginner strategy, the simple strategy beats experts. The people who are, often doing that most complicated stuff are losing to the beginner strategy because they're really just trying to like profit off of the, the margins, not actually have a better strategy.
You're right. And that's one of the reasons why you don't advise people to stock pick, but instead go into index funds, right?
Totally. Yeah. Stock picking is first of all, on average is the same as an index fund because all the stocks combined turn into an index fund. But when you pick and choose stocks, what you're really doing is you're just accepting more risk and more volatility for the same or maybe even a lower expected return net of transaction fees and bid-ask spreads and all that stuff. And so stock picking is basically a bad trade-off in investing. And so, I say, hey, don't pick stocks. Buy an index fund, which is basically a combination of all the stocks that you can buy at a very, very low fee, and that guarantees you your fair share of all market growth. So if you want to buy Apple and Tesla, like that's cool. But if you I own Apple and Tesla, but I don't own them individually. I own them inside of my index fund. And so when they go up, that's great. And then when there's some little biotech company I've never heard of that finds the next cure for the next pandemic or something, and that goes up, that's great too, because I own that one too. And so, but when you don't buy an index fund and instead you buy individual stocks, then you run the risk of like missing out on these or underperforming the market, which is what you want to avoid.
Exactly. And so I should mention, folks, that this is all part of Jeremy's two-part strategy for building wealth, which is living below your means and investing early and often. And so before we get to living below your means, because that's a really important part of this, you did that when you were paying yourself no more than $36,000 a year. A little bit deeper into the investment strategy, right? It's a lot of people on here who simply don't know how to invest their 401ks. And so what kind of guidance would you give around that?
So yeah, 401ks are a little bit weird. It's an employer-sponsored account, and so not everyone has one. You only have one if you work for a company that chooses to provide one. I think it's a little bit weird, by the way, that like us as American citizens, we like get access to tax breaks in investing only based on the whim of our employers. But you know, that's just how the world works right now. But yeah, you only get one if your employer offers one, and then you only get to choose from the investment options that your employer offers you. Again, super weird that I mean, you know, and I think the idea was that the government is trying to put the onus on employers to make it simple for the employees, right. But still, in my opinion, kind of weird. So once you're in that situation, then you basically look at the options they give you. There's a list of 20, and then, you know, what I recommend is ignore, you know, I think what many beginning investors do is they list these 20 different options, and they list the performance, the past performance. They say, this is what has happened the last 1, 5, and 10 years. And I've been guilty of this too. Like when I was in like my early 20s and I like saw it, I was like, well, I guess I'll just see what they did in the past and I'll buy the best one. But the problem is like what happened the last 10 years is I don't know what's going to happen in the next 10 years, but I guarantee you it's not what's going to happen the last 10 years.
Exactly. And no one can speculate on the future.
Right. And so people fall into the trap of just assuming it's going to be the same, but then that's actually usually what happens is underperformance, because whatever did really great, if you buy this like really speculative, you know, Indonesian oil future company or something crazy, like, you know, that had the best performance last 10 years, that might have the worst performance for the next 10 years, right? And so I say, ignore that. What you should be doing is looking at the expense ratios. So the expense ratios is how much these funds charge you to own that fund. And I would say anything under, especially in your 401k, anything under 0.2% is very low, and anything over 1% is very high. And often 401ks offer a mix of high expense ratio and low expense ratio. And the low expense ratio ones are index funds. And so if you just buy like a total stock market index fund, that's a very low expense ratio, and buy just that, inside of that you'd own thousands of stocks, and that's a pretty good option. Or you could diversify a bit and buy like a US index fund, an international index fund, and a bond index fund if they have it.
That is so important to note, because a lot of people don't understand the cost of investing as well. And because there is one associated with everything, right? Yeah. Low index funds with a low, or not low index funds with a low expense ratio. You said a low one is 0.02%, too high is 1%.
Yeah, 0.2% is that or lower, yeah. 0.02 does exist, but that's like crazy though. Like there's, you know, there's almost nothing.
Who's going to do that? But 0.2%. Okay. Yeah. And so you also talk about, you know, the different types of retirement accounts. We spoke about the 401k. What about people who are considering IRAs? Is there guidance around that? Would you suggest people also have an IRA even if they do have a 401k?
Yes. And so this, you know, this is kind of like my least favorite part of personal finance is all these crazy, no. I mean, it's not your fault. It's like a great question, but like, it's not either of our faults. It's like I said, it's kind of like the crazy rule set, because like all these 401k Roth IRA, all these are their fancy names that the federal government has given to a brokerage account. A brokerage account is just a regular old investment account. And so like, you know, we're all familiar with a checking account. And so you can go open up a checking account or a savings account. And then like the third kind of account really is a brokerage account. And the difference between a brokerage account and a savings account is in the savings account, you just put cash. In a brokerage account, you put investments like stocks and bonds and index funds, and all that stuff goes in a brokerage account. And that's, you know, I mentioned that because when people start getting lost in a sea of different named accounts, they're all brokerage accounts. 401k, a Roth IRA, you know, HSA, you know, SEP IRA, whatever. They're all brokerage accounts. And you could not do a 401k, you could not do an IRA, you could do none of that stuff, and you just could put all your money in a brokerage account, and that would be okay. The reason that I wouldn't suggest that being optimal is because you don't get a tax break for money that goes inside your brokerage account. And so to answer your question, I prioritize those specially named brokerage accounts that do offer the tax break. So the 401k is one, when you put money into a traditional 401k, you don't pay tax in it when you get paid. So like if you make $50,000 a year and you put $5,000 into your 401k, the government taxes you as though you only made 45,000. And then an IRA stands for individual retirement account, actually arrangement, because it doesn't need to be accounted. You could actually own like a property or something inside of an IRA, but most people, it's just an account. Yeah, I know. I think they actually do think you stand for individual retirement account, and they changed it to individual retirement arrangement so people could like more cleverly use their IRA benefit. But yeah, but you can open a 401k if your employer offers it, and then everybody can open an IRA, which is an individual retirement account. And both these things have limits, by the way. When you put money into an IRA, the most you can put in per year is $6,000 per year if you're under 50, or $7,000 per year if you're 50 and over. And the reason they limit that is because it's designed as a tool for like normal people, normal income people to save enough money to have a very healthy retirement, not for billionaires to shove like $1 million in their year or whatever.
Right.
So yeah, you can put $19,500 into your 401k if you're under 50. So between those two, you can put $25,000 a year away and have this great tax break. And if you're maxing out, if you're putting as much as the government will allow in both those every year, you'll be like well into the multi-millions over the course of an investing career.
Absolutely. I want to take a couple of questions from folks. Someone asks, Elisa, what happens if you get a 401k or an index fund with a higher expense ratio? How do you fix it?
So inside your 401k, one of the beautiful things about these tax advantage accounts, remember they're all brokerage accounts, but inside the ones with a special tax advantage, you can change your investments as much as you want with no tax implications at all. You can trade and the government's not going to try to charge you on your gains or anything like that. So if I had a 401k and I had, made the mistake that I made in the past by choosing a bunch of high expense ratio mutual funds, I would go take a look at my options again, and then I would just go switch them. And so basically everybody these days has a website for their 401k, and you log into the website, and they're all different, and sometimes they're confusing, and it might require that you call either the 401k provider or a person from your HR team, and then or you just go on the website and look, and then click a button that says like switch investments, and it'll ask, do you want to switch everything you've already invested or just your future contributions, or both? And I would probably choose both. And then you take all that money out of those high expense ratio funds and then choose the new low expense ratio funds, and then you're good. And then there's nothing bad that happens there. It's like a 1-for-1 switch, and you're off to the races.
Guys, I hope you got all that, because Jeremy is giving free game today on how to maximize free game. Really. Thank you for explaining that, because actually, was trying to explain the same to a coworker earlier this week. We were trying to figure it out together. But another question for you. Someone wants to know, when you had your first $2 million, did you invest 100% of it, right? And how long did it take you to get your next $1 million?
That's a great question. And, that question is this like lump sum question I get a lot, which is people say, hey, I have X dollars. What do I do with it? And I think the human instinct is to wait for the market to be low, and you've heard the market goes up and down, so you get in low and you get out high. But that, I basically say every human instinct that we've evolved with over, with the course of humanity, whatever, about investing is wrong. Humans, we're if we hear a twig snap and there might be a tiger coming to chase us, we've evolved to run or whatever. But with investing, that's not a good instinct. If you hear a twig snap investing, you should not run. You should just, be a robot and stay the course. And the same is true. So in my own case with my 2 million, I was reading all these books, I was learning about this, and I literally dumped it all in the stock market, that day or whatever. There's one day, and it's kind of crazy because I was literally still driving a 99 Ford Explorer, and I still had I had roommates and everything. And then I literally went on Fidelity's website, the site that I used my brokerage account, and clicked buy on these $1 million. And I remember sitting there, I was like, wow, some people work their whole life to pay off a home that's worth $200,000. And I'm making these $1 million, and I'm, what's crazy? I'm not even in the 1%. I think you need $10 million to be in the 1%.
You do, to be in the one, at least. Yeah.
Yeah, I know.
Wow.
I'm at 4. So it's crazy how much money some people have. So yeah, the answer is I dumped it in. And I think that's the best strategy, is to dump it in. You could also do what's called dollar cost averaging, where you split it up over the course of 6 or 10 or 12 months, and you just put in equal amounts every month, which is also fine. But what you want to avoid is is like putting in some, pulling out, waiting for, all that sort of like gaming the system is much more likely to hurt you than help you. And then, I hit my third million, I don't know, a couple of years later, and then I hit my fourth million. Like, I think actually I hit 4 million for the first time about 6 months ago. And now I'm almost at 4.5 million. It's cool because I'm still relatively young. I'm 40 now, but I'm in that like, when you chart, when you're early in your career and you're charting that exponential growth, like I got this like fast forward when I was 35 or whatever. So now I'm like, if the market goes up 10%, I make $400,000, which is crazy.
That's nice. And that's how the growth happens faster later. Later on, it's just because it's compounding interest,
Right.
What are you shooting for, a specific number?
I'm shooting for like maximum life happiness and like trying to help people. And so, I'm at a very nice point where like, so I'm not even in 1%. So I'm not like, building spaceships or whatever, but I can
good point.
I know. Like, I think if I try to fight with Bezos and, Virgin Airlines guy, I would lose that race. But I can direct my time as I see fit. So I do what I love doing, which is like I like helping people understand personal finance. And I go. In fact, like we had to reschedule. I had unfortunately rescheduled this a few weeks ago because we had this date scheduled, and someone asked me if I want to go on a 2-week sailing trip up the California coast, and I was like, yeah I do,
of course.
And other than unfortunately like stuff like this, I was able to do that because I didn't have a job that was like told me not to. So
and that's what a lot of people who come on this show, they talk about. First of all, a lot of people who come on this show are folks who have been in corporate America and they've worked it out, right, to where they have a business and they have more of their time now, right? And so that's what we talk about. We talk about wanting options, and being able to fix your life and your investments and the totality of your personal finance in a way that gives you choices, right? So that you can live the life that you want. And I love that you just explained it because, yes, it is possible for people to be able to do that. Like, what other kind of encouragement do you have for people who really want to reimagine their lives this way, if they don't know where to start?
Yeah, no, that's a great point. And I think it kind of comes down to like pop culture, just like, what we hear from our friends and stuff. And it's very like materialistic based, you just see like the car ads and like, the clothing ads and everything is like what the stuff you have. But in my opinion, stuff is a very fleeting taste of happiness, right? Like you might get like a little endorphin boost when like the Amazon box arrives or whatever, but then your baseline happiness, like immediately, like once you open it up, like, I'm talking like less than a minute sometimes, you're like, like then back to where you were, right?
Yeah.
But I think the things that matter are like freedom, right? Like choice with your time and relationships, and this isn't just me, this is like, you read studies, and the people that are happiest are the ones that like, spend time with their friends and their families and have like experiences and things like that. And so and I've had this weird life experience where when I was selling my company, there was like the day that we basically shook hands on the price, and I learned I was going to go from being basically like living around the poverty line to being a multimillionaire. And then the day that check actually cleared. And between those 2 days, there's almost 6 months, just because that's how sometimes these things go slow, and there's due diligence and et cetera, et cetera. And so for 6 months, I got to sit there and like have the thought experiment of like, I was nervous also. I didn't know if it was going to go through, and it did, thankfully. But I was like, what am I going to do with this money? And, once you, like when I sat with that for so long, the longer I sat with that, the more I realized like I could, my first instinct, I think, was the same as like I said, pop culture says like, go buy the Porsche or whatever, But then I was like, sitting with that. I was like, then what? Like, then I had this then I had to use Porsche a week later, and I had to explain to my friends why I'm driving a Porsche. It just seems so like vapid or whatever. It's like I'd much rather like like build a life than just like buy stuff.
That's good. I also know that you do love to give information. You're a giving person. Do you have a philanthropy goal or something that you want to do? I mean, it sounds like just mostly helping people out, helping people understand this, maybe on a grander scale. What's your dream to give? I always ask people this because many find it very important. I certainly do.
Yeah. I mean, I think that's, when you get very like cerebral about this, like what's the point of life? And I think the point of life is to be happy and to help people. I think those are the two things that like is what we're all here for. And if you can like achieve those things, then you're like living a good life. It's like pretty broad, but yeah. And I love giving back. Like, in fact, when I So when I started Personal Finance Club, it was just like I said with my friends, and I started Instagram just to like help people and like give this information. And after 2 years of doing that just for free with no goal of ever like, you know, having it be a business, I kept getting the exact same questions over and over, which is like, how do I do this? And so I built out this entire course. This was like this A to Z thing. And I was going to give it away for free because I was like, just the goal was just to like have this place for people to go to like learn A to Z. But then I thought more about it. I mean, it's, you know, I thought about, okay, if you give it away for free, people don't value it and they're not going to finish it. You know, if I give it away for free, yeah, I can't use the revenue to like produce more free content and help grow the thing. And I can't give. And so I basically said, okay, I'm going to charge for this like a really modest fee, but then I'm going to give 20% of sales away, not 20% of profits, but like 20% of every dollar that I sell goes away. And so that was not even a year ago. That was last October. And we've given away, I think, like $90,000 already. And so like every month
that's
we're
amazing.
donating. Yeah. It's like, so it's really nice for me just to be like, I was like, man, this is like an engine for good. And so, yeah, that's one of my philanthropy goals is to keep that up, you know, and like, I don't know how long that's sustainable, but I plan to do it indefinitely. Yeah. And so giving that away. And then, yeah, with my own personal wealth, I haven't like solidified this, but I'm kind of vaguely planning to just give it all away. You know, I don't need to die with a bunch of money. Like I don't currently have children. If I do, I think I would want them to like learn to like make something for themselves, not be like trust fund babies or whatever. So yeah, that's a big part of like my life. Yeah.
Your legacy will be teaching them how to do this, you know?
Right, exactly. I'd much rather.
But
no, you're right. Like,
totally.
I mean, my
sister and me talk about this all the time about how, you know, I don't have children yet, right? But she does. And she and her husband talk about how they don't necessarily want their kids to grow up privileged, but definitely knowing how to make things happen on their own. Right. So I'm right there with you. And you know what? I just have one quick question. I want you to answer this for someone. They ask, how do you determine how much money you keep in your brokerage accounts to pay yourself, but still allow your account to grow? Not sure I 100% get it, but maybe you do.
I think they mean once you're in retirement, how do you like live off of that money? Like it's, you know, and so, you know, the general rule of thumb is 4% is what you can take. It's called the safe withdrawal rate. So if you have $1 million in your investment accounts, you can take 4% of the starting amount of money when you retire. So $40,000 per year. And then historically, based on the volatility of the stock market and inflation and things like that, that's basically the safe withdrawal rate. That's like very unlikely to ever see you go broke over the remaining years of your life. You know, I'm living on probably less than 2% right now, just because I still feel very young and want to like, you know, continue to have my investments grow. But yeah, you know, and also I think people before retirement kind of get overly fixated on that. Like it's this very like mechanical thing. Like you have to take this exact amount of money, but like once you're there, you're like, okay, I've got a couple million in the bank or even $1 million, and you're not doing this in a vacuum anymore. You might still be working part-time. You can like, you know, you can change as your investments grow. It's not like you have to set this amount of money to take out and then you're stuck forever. You can continue to like make decisions. But yeah, I'm currently living on like maybe $50,000 or $60,000 a year, which is, yeah, like I said, less than 2%. And I just take it out of my brokerage account and let the rest grow.
Very good idea. Great. Well, hey, Jeremy, that's a good place that we're going to leave it. But I so appreciate you spending today with us. First off, thank you for waking up super early to be on the show with us here in California. So we appreciate it. And anytime you want to come back, of course, let me know. And folks, you can get in touch with Jeremy at personalfinanceclub.com as well as Personal Finance Club here on Instagram. I'm Renita Young, and thank you so much for joining Your Money Story. Have a lovely day, everybody. And you too, Jeremy.
Thanks for having me. Bye, Renita.
Of course. Bye-bye.